Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello and welcome to today's podcast. Thank you very much for being here. I appreciate it. Okay, before we get into everything, I just want y'all to know that on Thursday nights at 8:30 p.m. Central Standard Time, I go live on Facebook and go over my weekly meetings just to kind of give everybody an idea about what kind of people I'm talking to, what strategies we're using, all that kind of stuff. And the people that are attending seem to really like it. So tune in to my Facebook page at 8:30 Central Time, Thursday evenings. All right, y'all. Today we are going to be talking about creating an entity. We are back to Nelson's book, the chapter, Creating the Entity, and that is page 36. So as I always say, if you don't have Nelson's book, why? Go to farmingwithoutthebank.com, get it, grab it with the audio of Farming Without the Bank if you don't even have that, because we do have an audio version. So as you're sitting in your tractor, driving, doing whatever, you can listen to me. I had somebody tell me the other day that they listened to me while they had dinner. I'm glad to be their dinner entertainment. I personally would find that a little bit boring at dinner, but I truly appreciate those of you who do not find me boring. Okay, creating an entity. In this chapter, we are going to talk about the life insurance company, why they are picky, what they are doing, and why we need to create this entity. Because our need for finance is greater in our life than our need for death benefit. So I'm not going to read a whole lot from this chapter because it is a little bit more detailed, and I'm just going to try to sum it up for you. Basically, what Nelson is saying is that life insurance companies actuarially figure out who is healthy, who is not healthy, and through adverse selection, they get to decide who they want to insure. They need to know actuarially when it is likely that those people are going to pass away, because they need to know how long they have to put that money to work before somebody passes. This is all based on health. This is based on family history. So yes, you have to go through a health exam. Yes, they are going to get medical records. Do you want to put your money with a company that just loosely insures people that are doing drugs or committing suicide? No. We don't want to pay out more claims and not have an idea of when to pay those claims. People, keep in mind, these companies are 140 years old to 200 years old. Why have they been around that long? Why has it worked this long? Not because it's magic, but because they know how to manage everything actuarially. They know likely who is going to pass. Okay, has this whole pandemic COVID stuff affected them? Nope. They've paid some claims out, but they build in a little bit of a cushion that, hey, this many people are going to pass away most likely. And if they don't, the company makes more money, which is then given back to us as a dividend. Yes, a dividend. So we all understand that a dividend comes to us if we have a bank that pays us a dividend. And that dividend is going to come back to us, and then we are so lucky we get to pay taxes on it and claim it as income. When we get a dividend from the insurance company, we do not have to pay taxes on that because A, it goes back into the policy and buys more paid up insurance, but it is a return of premium. Because the insurance company said, hey, I charged you X amount for premium, but because we didn't use that and less people died than anticipated, we made some extra money. So I'm going to give that back to you. That is not a taxable event. So do we want the insurance companies to be picky? Yes, absolutely. Do I want them to be picky when people are not, because they're going to look at your finances as well, not just your health. They're going to run credit reports. We had a couple that did not tell us that they had money in collections. And then they did not tell us that they were tobacco users. And it came back that they're tobacco users. Well, now we have 2 warnings, right? They lied on their application. Is that a red flag? All day long. Do I want them as an insured? I'm not so sure. If they thought it wasn't a big deal that they had 6 figures of debt, that's alarming. To the insurance company, why aren't you telling me that? Why are you lying to me that you're a tobacco user when you tell me you're not? You're most likely going to die sooner. If your doctor says, hey, I don't know why the insurance company is making such a big deal about this, it's not a big deal. Okay, it might not be a big deal to them, but it's a big deal when there's money at stake and they're going to have to pay out a claim and they don't know the details, or all their medical information tells them that we're going to most likely we're going to have a claim on this sooner for this person because of X illness, which your doctor might not think is a big deal. I really used to get mad at insurance companies when they came in and said, well, we can't insure this person because of XYZ. Well, you can't insure them because we want to make sure we mitigate and we know what to do with our money, and that business is there for another 121 years. I am writing policies all the time on newborns. I don't want this company or my companies to just fall by the wayside. Yes, I want them to be picky. I want them to make sure that they're getting all the information they can. There are some companies that will do underwriting in 2 weeks. I mean, that blows me away. You're not even looking at medical records just because they're young and healthy. We're not looking at medical records. It's unbelievable, you guys, how many young and healthy people, supposedly young and healthy people I have that aren't so young and healthy. Right now, I have a wonderful young lady in her 20s that has a kidney issue that can be fatal. Absolutely fatal. If you don't get a kidney transplant, you are going to pass away. And this just started showing up. It is a family inherited disorder, disease, whatever you want to call it. And she is in her 20s. Serious. Very, very serious. So just because people are young, the insurance company cannot say, oh, well, this is fine. It's only $100,000. There are companies out there that do that. That's risky to me. Why is a company putting themselves at risk? So we want to have a company that is a little bit picky because this is where we're putting our money after all. I don't want that company to go under just like a bank would. No, thank you. So then Nelson goes on to talk about retirement at the age of 65, that we've made up this whole thought process that we need to stop working at 65. Do we need to stop working at 65, or are people just telling us to stop working at 65? Nelson always said, show me in the Bible where it talks about retirement. It doesn't talk about retirement. We just think we should be retiring. But on page 36, he has a graph. And in that graph, it shows how many people are going to live past 65, have the need for retirement, and how many people are going to pass away after 65, and how many are going to live to 65. So we also have this, we're going to have a need for money all the way to death, right? We need money, but we are unlikely to die before age 65. So insurance companies come in, or insurance agents or talking heads, wherever these talking heads may be in the country, right? Say you need to have insurance until you're 65. From 21 to 65, you need to have insurance because that is when you have debt. After 65, you don't have any debt, so you don't need any insurance. So they're touting insurance for the time that you're less likely to actually die. How about instead, we have the insurance for our whole life and we create a policy with money in it that we can also use the money because we are more likely to need that money during 21 to 65, not the death benefit. Why is insurance cheap until we're 65? And he explains this in the policy as well. And this is something in this chapter, he explains this in this chapter as well. And I really want you guys, if you have this book, I want you to actually read this chapter because I am not reading it to you. I'm just explaining it in an overview. Why is term insurance cheaper? Because when we buy term insurance, they say, okay, you're 30 years old. Chances of you dying is very little. So we don't need to collect as much money because we pretty much know we're only going to pay out 1% to 2% of any policy sold before 65. We're only going to pay that out 1% to 2% of the time. So out of all the term insurance, 1% to 2% of it gets paid for death benefit, right? So it can be really inexpensive. Why then over 65 is term insurance so expensive? Because you're more likely to die. No one's getting out of this free. No one's going to live forever. So why does it quadruple at 65? Because you're more likely to pass away, and they know they're going to have a higher percentage rate of those claims being paid. So term is cheap when we're young because we're not going to die. So why is whole life so expensive? Because we're going to die on their watch. Those whole life policies go until age 121. We know that if I buy a whole life policy today at age 30, I am going to need X amount of premium until age 121 to make sure I can pay that death claim. Right? If I was going to give you, and what Nelson is saying is that, and I'm going to read this part. In creating plans of purchasing life insurance, all calculations by the rate makers begin with the cost in a single sum of providing a plan of insurance that would cover one for the whole life. This is called a single premium life insurance. The insured plunks down the single sum, and insurance is guaranteed for the rest of his life. Okay, so the insurance company says, if you're only going to pay premium one time and I have to insure you the rest of your life, I need X amount of money. Term insurance says, okay, well, I only have to insure you for 10 years, so I only need X amount of money. What do you think is going to be cheaper, to insure you for 10 years or 80 years? Probably 10, right? So now the life insurance company has a base for whole life. If you pay me one lump sum today and I have to insure you for the next 80 years, this is what I need. But if you pay me over 10 times, which is a 10 pay, if you pay me 10 times for the next 80 years, what does that cost? Probably going to be a little bit less every year, right? How about 20 times? How about if I paid on it till I was 95? They just take what they know it's going to cost over your whole life and they break it down according to how many years you want to pay. So again, why is it more expensive than term? Because I'm going to get paid until I'm 121. I know I'll have death benefit up until age 121. With term, it's going to be 10 years, 20 years, 15 years, whatever. I have done the math. Term is not cheaper per dollar of death benefit than whole life. If we're going to say we're going to compare to age 95 or 100. We can't even compare to age 121 because term doesn't go out that far. But even to 95, it is more per dollar a death benefit if you have to buy insurance after 65. Please show me a farmer who does not use money after 65. Please show me any individual that is not buying anything until after age 65. Let's be realistic, people. There are farmers buying land at 65. So you're not supposed to have any insurance after that? Okay, so they're supposed to sell some land to pay for the funeral? They're supposed to, we're going to just haul a load of grain in because we got to pay. Dad passed away. We need about $15,000 to pay for that funeral. So let's haul some grain in. Yeah, that's what they want to be doing when people pass away. Hauling some grain in, selling some land, selling some equipment, starting a GoFundMe account, right? How many GoFundMe accounts are started because people don't have life insurance? And if you are young and you can't afford whole life, then buy term. I have nothing against it. If we need the death benefit and you can't afford whole life, then go get some term insurance. So what is needed today? Nelson goes on to say, whole life should have been called a banking system with a death benefit thrown in for good measure. Because if we're not going to die when we're young, what do we need? Cash. We need money to finance stuff because we go to the bank. If we don't have the money, we just go to the bank. Well, goodness gracious, wouldn't it be nice just to have to go to our policy and have the death benefit there? Killing two birds with one stone, right? And we don't have to start big. You don't have to have a $100,000 premium. I have people with $3,000 premiums. I have people with hundreds of thousands of dollars of premium. It all depends where we're at. But our need for finance is much greater than our need for death benefit. As Nelson told one of my colleagues, how many times do you die? Once. How many times do you finance something? A lot. And then in this chapter, he goes on to talk about conditioned thinking and misclassification. And I really like this because he talks about misclassification. He brings that word up about 3 times in this chapter. And he talks about how, they went and found the potato and the potato was supposed to be poisonous and now everybody's eating potatoes, right? Because we misclassified it. We didn't have the right thought process. We didn't know what it was. Very much like whole life insurance. We automatically classify it as expensive and horrible, even though we don't know what it is. Well, if we educated ourselves and found out what it was, like the potato, maybe everybody would have it because they would see that it's awesome, right? Add a little gravy. He said, the world seems to always behave that way. We pick up some screwball idea that is based on a half-truth and let it grow into a monster that blinds us to what is really happening. Think about that. We pick up a half-truth and think that it is, and we just believe what everybody's telling us to believe. Oh my gosh, with what's going on right now, with life insurance, with farming, with our food fights, right? All of that. We are believing what people are telling us to believe. Are we actually educating ourselves? I had a gentleman that I talked to the week of this recording, and I was like the second agent he talked to outside. I was a second infinite banking agent. He also talked to another agent that didn't know anything about infinite banking or whole life. He was trying to sell him another universal life, which was absolutely ridiculous. Anyway, the guy read my book. He read Nelson's book. He's listened to all the podcasts. He has done his homework. And guess what? Even though he worked with another agent that understood what Nelson was trying to teach, he also understood that that agent did not understand farming. That agent was showing him illustrations without meeting with him. My strategy was 100% different than everybody else's because I actually sat down, had an 1.5 hour meeting, and figured out what was going on with his operation. I'm not saying that that guy's going to do business with me, but boy, oh boy, I'm not going to be sending illustrations if I haven't talked to you because I don't know what's going on. How can somebody give you advice, and why would you expect somebody to give you advice if they only know the half-truth or half of the story? We have to know the whole story. And when I have meetings with people and they say, well, I don't know how much to tell you. I'm like, well, tell me it all. Because if there is a piece I'm missing, guess what? That might be detrimental to our strategy. I need to know it all, right? Sometimes I have to say, use more words. Use more words. We have an 1.5 hours for every meeting. We can get done what we need to get done. Maybe we just need to talk a little faster, but at the end of the day, we do need to, we end up, most of the time, very rarely do I end up having to do it again. Then in this chapter, he goes on to talk about the modified endowment contract, or MEC, as a lot of people call it for short. I do not talk about that in my book. Why don't I talk about it in my book? Because Nelson talks about it in his book. So if you've never heard about the MEC line or the modified endowment contract line, again, go to farmingwithoutthebank.com and get Becoming Your Own Banker. On page 38, he talks about it. This is the line that the faster we can get money into the policy, into cash value, we can fill that up. As soon as we fill that policy up, we have to make sure that we are right up against that line. If we put too much cash value in the policy, it all is going to grow taxable. We want it to grow tax-free. So we have to stay underneath that line. When we structure a policy, we are always underneath that line. The life insurance company makes sure that your policy is never going to MEC. But why is that line important? Because when we are structuring a policy for cash value to have a lot of growth right away, we have to be aware of that line. Before the MEC line was ever created, millionaires were sticking millions of dollars into life insurance. It was all growing income tax free. You could do a single premium. You could put $100,000 in and never pay premium again, and it would all grow tax free. The government came in and said, no, we got to change that. And people will ask me all the time, well, is the government going to change this now because everybody's doing it? Okay, maybe, but we would be grandfathered in, right? They couldn't change anything in the past. They might change things going forward. And I truly believe this is the reason why people don't have whole life insurance anymore, because they created the MEC line and people said, okay, can't do it anymore. We're going to go to the market. Instead of saying, let's just start more than one policy. Why did Nelson have 49 life insurance policies? Because he would hit the MEC line and he would just start another policy. Not a big deal, right? But those of us that don't think that way go, oh, well, we can't do this, so we're going to have to go to the market, put our money at risk, and that's what everybody's telling us to do anyway, so that must be a really good idea. Is it? Or do we just not think about it correctly? Back to the potato, right? We just didn't think about it. We didn't educate ourselves. And now we think we can't use it, when in fact we can. We just got to do it different. We just need more than one policy. And why does it matter if it all grows taxable? Because life insurance, if it does not MEC, it is first in, first out, which means the money I put in first, I can take out first income tax free. Okay? If it does MEC, it's first in, last out. Which means when I go to take money out of it, guess what? I'm going to take the growth. When I go to take a loan, I'm going to take the growth. And then I'm going to have to pay tax on that. So I don't want to pay tax on that. So I just don't want to cross the MEC line. So I get what I put in first. And then if there's growth, I'm just going to borrow against it to not pay any taxes. Then Nelson goes on again to talk about Christopher Columbus and misclassification of people that were classified as Indians that were not Indians. He said there are probably thousands of such examples of misclassification that we run into every day, but they probably don't increase the quality of our lives. Instead, they limit our thinking and lead us to wrong conclusions. Words are powerful things. Yes, they are. And when I look at people that say, yep, my agent told me I have whole life. No, you have universal life, you have variable, you have indexed. What you have is a permanent life insurance product, but it is not a whole life product. It is permanent, and under permanent is universal, variable, indexed, and whole. That is misclassification. People will call all these other things whole life because they are misclassifying it. If you are going to misclassify something, it is because you don't understand it. So if you educate yourself and you understand it, guess what? We're not going to have a problem. When people say, I'm going to take money from my policy. No, you're going to borrow against your policy. Don't misclassify how you are using that money. If you take it, you can't put it back. It's gone. You took it. It's like taking it from savings. If you borrow against it, you can put it back and it continues to stay in there earning uninterrupted compound interest. Totally different things. Don't misclassify. And yes, I will correct you every single time that you do it, because I don't want you misclassifying that. When you call the insurance company and say, I want to take money, and they process that as a withdrawal versus a loan, that's a big deal because you can't put it back in. Okay, that's all, you guys. There's a lot in that chapter, and I summed it up. So go get the book and read it. I don't know how many times I can say that before I annoy the crap out of you. However, I thank you for being here. Please share these with people. I'm glad that they are helping educate you on the infinite banking concept because it is about banking. It is not necessarily about life insurance. Even though we just talked about creating the entity, not every company allows us to do it the same way. Not every company is as flexible. And that is important when we are talking to farmers and business owners because you need flexibility. What if you have a bad year? Your agent needs to understand your industry. As always, if there is something that you guys need, email me, maryjo@withoutthebank.com. I am happy to answer those. If you have a subject you want to talk about, please let me know what that is, and I will talk about it. Sometimes you guys email me and I don't talk about them, and the reason why is because it's either something that is a little too detailed or it is something that is maybe too direct to an individual's finances. But I do try to talk about everything that you ask me to talk about. All right. Let me know if there's anything else I can answer for you. maryjo@withoutthebank.com. And we will see you in the next episode.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.